Welcome to our deep dive on the hidden costs of co-owner buyouts when a property is tied to a very low mortgage rate. Today, we will explore why separating ownership can be financially tricky, what standard financing allows and prohibits, and the realistic pathways to a clean buyout while prioritizing the remaining owner's stability. We'll use a working example: a $500,000 home with a 2.3% mortgage rate and $150,000 remaining debt, which implies about $350,000 of equity. We'll show why you can't split one property into two separate primary mortgages, why removing a co-owner usually forces a payoff and a new loan at current rates, and how options like a full sale, a loan assumption, or a cash or HELOC funded equity buyout might work. Let's begin. In this agenda, we'll first cover why low-rate mortgages complicate co-owner buyouts, then clarify what standard residential financing permits. Next, we'll examine three practical options: full sale and refinance, loan assumption, and equity buyout via cash or HELOC. We will also walk through equity division, paperwork, and tax considerations. After that, we'll present a decision flow and example numbers, and wrap with an action plan and quick quizzes to test your understanding. Let's transition into the core problem. Co-ownership gets complicated when you want to buy out a partner while keeping a very low mortgage rate. The system is not designed to allow two different individuals to hold separate primary mortgages on the same single property. In addition, removing a co-owner from an existing joint mortgage typically requires paying off the original loan entirely, which means the remaining owner would need a new loan at current market rates. That can be significantly more expensive than the original financing. With that groundwork set, let's move into why these constraints exist and what they mean for your wallet. Low mortgage rates make buyouts difficult because standard residential lending structures do not allow two separate primary mortgages on the same property. To remove a co-owner from a joint mortgage, lenders usually require paying off the original loan in full. That payoff necessitates new financing at current market rates, which can be materially higher. The favorable rate is linked to the existing loan's terms, not the property or the borrower individually. Consequently, trying to access equity through a buyout can unintentionally force a refinance that eradicates the low rate advantage. With that challenge defined, let's transition to the pathways that can still make a buyout feasible. There are three pragmatic paths to facilitate a buyout by a third party while prioritizing the remaining owner's stability. First is a full sale and refinance, which is the cleanest approach administratively, but sacrifices the existing low rate. Second is loan assumption, a rare but powerful option if the existing mortgage is assumable, as it can preserve the low rate for a qualified buyer. Third is an equity buyout via cash, or HELOC. This requires that the remaining mortgage holder qualifies to remain the sole liable party on the original loan, and that the lender agrees to release the exiting owner from liability. Let's detail each, one by one. In option 1, you list and sell the property outright. The new buyer secures a new mortgage at current market rates, which pays off the existing loan. The sale proceeds fund the equity distribution based on the agreed formulas and ownership contributions. This offers the cleanest legal and financial break, fully separating the parties and liabilities. The trade-off is that the existing low-rate mortgage is lost. It is simple to administer and easy to document, which reduces ongoing entanglement. Now, transitioning to an alternative that may preserve the low rate, let's explore loan assumption. Option 2 relies on the mortgage being assumable. You should verify this with the lender as soon as possible. If the loan is assumable, the incoming buyer applies with the lender and must meet underwriting requirements. If approved, the buyer takes over the existing balance at the original low rate, preserving the rate's financial advantage. A crucial protection is securing a formal release of liability for the exiting co-borrower so they are not tied to future payment risk. This approach is uncommon, but can be highly beneficial. Next, we'll discuss an approach that may work even if the loan is not assumable. In option 3, the existing loan remains in place at its favorable rate, assuming the lender allows the remaining owner to be the sole liable party and releases the exiting co-borrower from liability. The incoming buyer funds the buyout with cash or their own HELOC. Title is updated to reflect ownership changes, and legal agreements document the buyout amount, contributions, and ongoing responsibilities. This route is a negotiation-intensive process and depends heavily on lender cooperation. Now, to help you visualize the decision process, let's look at a flow diagram. This flowchart provides a high-level triage. First, Determine if the loan is assumable. If it is, apply for a loan assumption and verify buyer qualification. If the buyer qualifies, the assumption preserves the low rate advantage. If the loan is not assumable, or the buyer does not qualify, consider a cash or HELOC funded buyout. That route hinges on the lender agreeing to release the exiting co-borrower from liability. If the lender will not release liability, the clean path is a full sale with new financing. With the roadmap set, let's test your understanding with a quick quiz. Quiz time. Question: which option can preserve the original low mortgage rate if allowed by the lender? Options are A. Full sale and refinance, B. Loan assumption, C. Equity buyout via cash, or HELOC without lender release, D. Taking out two primary mortgages on the same property. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is loan assumption. When a mortgage is assumable and the buyer qualifies, the buyer can step into the existing low-rate terms of the original loan, preserving its financial benefits. Next, let's quantify the payment impact of losing a low rate. This table shows illustrative principal and interest payments to highlight the magnitude of rate differences. On $150,000 over 30 years, a 2.3% loan yields an approximate monthly payment near $578. At 7.0%, the payment jumps to around $998. If a buyer must finance $350,000 at 7.0%, the monthly payment could be around $2.329, compared to approximately $1.348 at 2.3%. These are back-of-the-envelope estimates for educational purposes and exclude taxes, insurance, HOA dues, and closing costs. Your actual numbers will vary based on term, remaining amortization, lender fees, and underwriting outcomes. Now let's visualize assumptions as a process with a sequence diagram. This sequence diagram depicts the interaction flow. The buyer initiates an assumption request. The lender outlines requirements, and the buyer submits financial documentation. The lender underwrites and either approves or denies. If approved, the lender issues assumption terms at the original rate and remaining balance. The seller requests a release of liability. The lender may grant it if conditions are met. Title or escrow then updates records, and closing occurs. Afterward, payments continue under the assumed loan. With the process clarified, we will turn to equity division and documentation. Equity division should follow a clear, agreed formula. Begin with market value minus the current mortgage balance and any selling or transaction costs to calculate net equity. Then adjust for individual contributions, such as an unequal down payment or one party bearing a larger share of the mortgage over time. All terms and amounts should be formalized in a written buyout agreement, including timing and responsibilities. Use a neutral appraisal to anchor the market value and memorialize any offsets, credits, or reimbursements. Now let's address tax considerations. Tax outcomes depend on individual circumstances. Gains on a sale above applicable exclusions may be subject to capital gains tax. U.S. rules commonly referenced include a primary residence exclusion up to $250,000 for single filers and up to $500,000 for married couples filing jointly, subject to qualifying criteria such as ownership and use tests. Adjusted basis, including capital improvements and eligible costs, affects the calculation of gains. State and local tax rules can also influence outcomes. It is critical to consult a qualified tax professional before finalizing any transaction. Now, before we move forward, a brief but important disclaimer. Disclaimer. This content is for educational purposes only and does not constitute legal, tax, or financial advice. Every situation is unique. Before making decisions, consult your lender regarding loan terms and eligibility, a real estate attorney for contract and title matters, and a qualified tax professional for tax implications. With that noted, let's continue and reinforce key financing constraints with a quick check. Second quiz. Question. Under standard residential financing, can two different individuals each hold separate primary mortgages on the same single property? Options are A. Yes if both agree, B. Only if the lender approves a split mortgage, C. No, that is not standard practice, D. Yes, but only for up to 12 months. You may pause the video now to consider your answer. We will discuss the answer in the next section. The correct answer is No, that is not standard practice. Standard residential financing does not support two separate primary mortgages on the same property. This is one of the core reasons co-owner buyouts are challenging. Now, to ensure you can take action, here's a step-by-step plan. Follow this plan to turn concepts into action. First, verify whether your loan is assumable and obtain written confirmation. Second, quantify your situation, including current balance, market value, foreseen transaction costs, and a proposed equity split. Third, determine your priorities: preserving the low rate, achieving a clean break, or maximizing speed. If the loan is assumable, pre-qualify the incoming buyer and request a formal release of liability for the exiting party. If the loan is not assumable, evaluate a cash or HELOC buyout and confirm whether the lender will release the exiting co-borrower. If the lender will not release liability, plan for a full sale and new financing. Throughout, document all terms and consult appropriate professionals. Finally, coordinate closing tasks and update title and ownership records. This comparison highlights the trade-offs between full sale and loan assumption. Full sale and refinance provides the cleanest break, is straightforward, and is often used when the lender will not release the exiting party from liability. The trade-off is losing the low rate. Loan assumption preserves the low rate but requires that the loan be assumable and that the incoming buyer qualifies. It also demands a formal release of liability for the exiting owner. It's less common and more process-intensive. A third option, the cash or HELOC buyout, sits between these two in complexity and feasibility, depending heavily on lender cooperation. Here are key formulas and reminders in concise form. Net equity equals market value minus the mortgage balance and transaction costs. In our example, $500,000 minus $150,000, less any applicable costs, leaves about $350,000 in net equity. Rate differences significantly affect monthly payments, even when principal is unchanged. For assumptions, verify the loan is assumable, confirm buyer qualification, secure a release of liability, and ensure title is correctly updated. For cash or HELOC buyouts, confirm lender willingness to maintain the existing low-rate loan while releasing the exiting party. We covered why low-rate mortgages complicate co-owner buyouts, why two separate primary mortgages on one property is not standard, and the 3 realistic paths to a clean buyout. We discussed how to divide equity fairly, the importance of thorough documentation, and the potential for capital gains taxes and other tax implications. Throughout, we emphasized lender approvals, liability releases, and using professionals to avoid costly mistakes. To close, here's a final visual call to action. Thanks for watching. If you found this helpful, please like the video, share it with someone navigating a co-owner buyout, and subscribe for more guides on real estate finance. Drop your questions, experiences, and strategies in the comments. What would you do to preserve a golden mortgage rate? Your insights can help others make better decisions.